Okay, hello everyone. Welcome to this week's weekly study session, April 13th, 2024. We got a lot to cover this week. Starting with the key components of market health, major indexes still negative. Of course, they worsened last week. I'll go over that in just a second. Up, down volume went from neutral down to negative. New highs, new lows went from positive to neutral, and individual stock participation was also already negative. So you can see we're getting a worsening picture as far as the key components of market health, and that's showing up not only in the general market, but also in many of the individual stocks. We've definitely felt some pressure going into the end of the week in particular. I want to make sure all these comments are kept into perspective. I do still believe, or at least forget about my opinions. The main thing is that the evidence and the trend is up right now for the SPY, the S&P 500. Our models are on a buy signal from the January 13th and the November 17th, the 33 and the 25. So it would take quite a bit of downside action to switch to a downtrend or a sell signal, a longer term sell signal based on the long-term trend models that we follow. However, in the short term, what really matters as far as trading stocks are stocks themselves. And that's why we have two completely separate components. One just looks at just the index and the other looks at just stocks. And the just stock component is the STEM model. And that has been on red, of course, deteriorated from green down to orange, now to red. And that's really in the near term. That's what's most important. You don't have to look very far to see, of course, the end of the week here. Open positions came under pressure. Feeling that pressure, as I pointed out, I did like what I saw on Thursday with some stocks setting up. Some of the indexes held up quite well, but I did also point out that I thought this could be a head fake and just the calm before the storm, if you will, and be prepared for an abrupt failure. So I wouldn't say we got a complete blowout failure, but certainly the end of the week here, Friday was not what we would want to see on the bullish side. It was quite negative. We got the Dow, of course, is rolling over the most out of the indexes. Some of the indexes are holding up quite well as far as the S&P 500 is still holding up well, the NASDAQ, but as I'm going to point out in just a second, I think those are going to give way soon too. But the Dow was the weakest. It was one of the first ones there to come under the 50-day, and then I very quickly, the very next day, I shorted that uptick, that up day, and then a couple days later doubled up on that and went overweight. So we're still, of course, holding that short, and by default, that is turned into a portfolio hedge, if you will, as far as the open positions are concerned. And as we bleed out open positions or longs hit their stops, it becomes a bigger hedge, right? The portfolio gets tilted, or the open positions get tilted into being more hedged and having more of a short position versus the longs. Looking at this is the Dow right here. It's a weekly, and you can see we closed right on the low for the week. If you look at the Dow, also another thing that led me to a lot of people ask, why did you pick this index and the other one? And as you know, you've seen before, there's times where I get the wrong index. It's somewhat of a crapshoot, but we tried to make a best case for it, looking at the relative strength and the indexes that look the weakest when we do short. The relative strength on the Dow is just, drastically underperforming the S&P 500. And they're very similar, but of course, Dow is 30 stocks, price weighted. S&P 500 is 500 stocks, market capitalization weighted. Of course, the NASDAQ is also market cap weighted, very heavily tilted towards just a handful of names. But again, we're rolling over there in the relative strength. Best guess for a target. I know people like to hear targets and where I think the market's going, but my best guess is that, we can come down and undercut this low here and maybe even get down near the 200-day moving average or undercut it. That would be, somewhere in the neighborhood of 8, 10%, maybe 10 or 12% if we I think if we got really exacerbated here to the downside, maybe 15%. But again, I think this would provide a buying opportunity. It may not happen right away. It may take some time, take some base building, but this is where you want to really start keeping your eyes peeled for the stocks that are holding up the best, building basis, and getting ready to buy those stocks, not after the market is moving out of some base structure or going into new high ground, but coming off of the lows, and you get that first accumulation day or follow through day, and then you start looking for stocks. You start buying those stocks that you've already teed up and have been holding up well, sometimes for months before or at the time that the market bottoms. Nasdaq is holding up really well, and this is a clear relative strength shift, or I should say, a clear relative strength play from interest rates moving up here, which is beneficial to the big tech companies. And you can see where the Nasdaq is held up, and many of those big market cap names have held up relatively well with even Apple popped back quite a bit. I still think that's probably a short on strength, but versus the smaller cap like the Russell 2000, which are coming under pressure again because the prospects of a Fed bringing the rates down is dimming, of course, because of the sticky inflation numbers. Now, looking at the Nasdaq, though, there's a couple things here. We've got about 10 distribution days, so there's a lot of distribution. That's a really large number of distribution days without the market correcting. And you've got these 2 days in particular. You see these big days right here and right here, where we come up to that 16,000, I don't know, 450 level or so. And then we came back to that level. Everybody was all excited that we erased everything, and we came back on Thursday, only Friday to come back off here. And that was on low volume. You see here, it wasn't much volume. And I think that there's really a formidable opponent, if you will, or formidable supply at that level. And we need to break out into new high ground on the Nasdaq and even hold there and see some broadening in participation. Sorry about that. Before we get too bullish here and think that this is like relative strength. This is really just sort of the last of the Mohegans holding up here, I think, because you take a look at the percentage of stocks above their 50-day moving average on the Nasdaq. Now, we haven't yet closed below the 50-day on the Nasdaq, and as you can see, we've held that for a long period of time since we started rallying in November off the lows, but we're deteriorating dramatically. There's only 32% of stocks above their 50-day, and this is just breaking down. So that you can see that the market is correcting beneath the surface, but it's those few names that are holding it up here, the heavy market cap weighted. So that's why you're going to feel pressure in your portfolio because most stocks are going down at this point. Now, also, which is even more ominous, if you will, or certainly a warning, is the fact that we cannot get above the 50% level in stocks above their 200-day on the Nasdaq for a long period of time. And now it's starting to break down. 41% of stocks are above their 200-day, or about 42%. So that means more than half of the stocks in the Nasdaq are below their long-term 200-day moving average. And this is a tune I've been singing for a while, but it's really getting stretched here. And you can see we're a good distance away from the 200-day. And now, as we're starting to see this distribution, you really got to take that seriously. When I see this lack of participation, and then I get the distribution, that's where I'm looking to move into cash and step aside, or even short. And we take a look at something like the Dow. Of course, that broke down the most here, but you also have the Russell also closed below the 50-day. Even the MDY, the mid cap 400, we got that to close last week. Trading around the low, and that closed below the 50-day also. Now, the S&P has gone up, is logged in 22 or so all-time highs this year, about 25%, and hadn't gone more than an entire year without experiencing a one-day 2% decline. This is the sixth longest since 1965. And again, that doesn't mean it can't go longer. You can see in 2007, we went 950 days, quite incredible. So certainly it doesn't mean it can't go longer, but when you start looking at the interest rates turning up here, and as I pointed out, if interest rates break out, that's where we're not going to be able to withstand this rising interest rate, this 1 year rising, in the 10 year too, for very long. The market's not going to keep rallying with rates moving up, and that's sort of how the ice was melting beneath the surface here. And now we're going to have to see if rates continue to accelerate here. We may get more pressure here. Of course, there was major cold water, thrown on the probabilities for a Fed rate cut. It was almost a certainty that we were going to get, a May rate cut just a month or two ago. If you remember, I said I did not think that was going to happen, and now, of course, it's about a 5%. So the probability has diminished drastically. Some are talking about, analysts are talking about maybe not even having any rate cuts or just one rate cut in 2024. So now, as we're coming from an overbought condition, and we're seeing the S&P 500 overbought, these market indexes overbought, and that, of course, has come with a lot of bullish sentiment, bulls versus bears, where we got high bullishness and low bearishness. And the bears, you can see, haven't come up at all. The bulls are starting to roll over a little bit last week, coming from 62% down a couple percent, but we're going to need to see bearishness come back in the market, and this is going to have to definitely pinch in closer, where the bulls and bears start to contract and rise here respectively. Now, the other thing, this is just a whole kind of big picture forming here, because we also haven't gone, or we've gone a long distance without having 150% rise in volatility. This is another thing I've been pointing out for quite a while, but I think, the chickens are coming home to roost right now. We just had volatility turn up and make a new high. This is something, as you know, I've been expecting for a little while now, as we've kept that volatility very low. Return back into the 20s and maybe even up to those sort of bear market warning levels. I think that's where we would look for a low. If we can get and take out these highs here, get into the 20s, mid 20s, or get anywhere near 30, that's where you start looking for some type of bottoming action if we truly are just having a correction within a bear market. The the S&P 500 has held up really well, and just finally is starting to roll over here and taking out some of the moving averages that it's been holding above. I pointed out last week, actually, this chart is not updated, I apologize, but we were very overbought on the Dow, and now we've come down into oversold. And that first oversold thrust, sometimes you get a rally, but usually need a little bit more time. Now, uh, I also talked about this idea of the low volatility in real GDP, and how that has coincided with bull markets, and that is the stark difference between the pre-1980 sort of Reagan era, and going back into the 60s, the 70s, where you had very wide swings. And right now we're in that Goldilocks narrow window. Now, of course, that came off of some big volatility, and that's why the Fed's nervous. Some studies point to a effective inventory management, and better information technology, and just technology itself overall being responsible for taking down that volatility. And also, for quite a while, the argument was that's what put inflation down. I think it's absolutely true that we have technology and certainly inventory management. Dell was one of the first to come up with the build to order. That's how they put big pressure on Compaq Computer. Compaq had all these computers built, and they were sitting, and because technology moves so fast, those computers are like fruit sitting in the sun, right? 6 months later, they're not worth nearly as much as they were, because new technology. And Dell was doing the build to order. They would not keep any inventory. So until you made an order, once you made an order, then they would build it. So they weren't holding any inventory. And that sort of started a whole new model. And now we're a long way from that. That was in the 80s, and I lived through that and saw that technological shift. But now, of course, for quite a while, and you can see also, if you look at this chart, you can see how the durables, coming down the 1 year supply of inventory. That's pretty telling of what's happened and how technology has improved that efficiency. But monetary policy is also a big big part of it, in my opinion, at least. Now, talking about everybody's, talking about how mortgage rates are so high and interest rates, have to come down because they're so high. Actually, if you take a look, you look at Fed funds, you look at the discount rate, you look at these rates, they're really just back to pretty much normal levels. I mean, for the grand majority of the time, we were for the last, the post World War II, we were above these levels, much above these levels in the 70s and part of the 80s. Really, if you look, the low interest rate levels were around recessions and around a very aggressive monetary policy and QE. And that's that very abnormal period. You see right here, this long period of very low rates. This is an abnormal aberration that is artificially inseminated by the Fed. That is monetary policy. That is not inventory management. So, and I would expect that to continue if we were to roll over in the economy. You're going to go right back to printing money and rates coming down at some point. But right now, it's just the opposite. We've got fears that we're going to see inflation. And if you go back and you take a look at the 70s and go into the 80s, we had a similar situation where the inflation moved up and the fear surged with it, and then it subsided a bit. But we had sort of a double rise, as opposed to not a double dip recession, just the opposite. We had a double rise sort of inflation, and recently we've had business optimism really collapse, and that came off of course, uh, much higher levels of concern, and now we may get, if you go back, you remember I made the argument about looking at the inflation rate versus the 5-year moving average. Matter of fact, let me move to this chart right here, and how we were at those similar levels that we peaked back in the 70s and 80s. But now, if you look forward here, we may be in the middle point, similar where you come down, but you haven't really broken the back of inflation yet, and you turn back up here, and that's where we could be getting, going back to that chart of the concern, if you will, where maybe that concern turns back up. And that's one of the concerns of the Fed. And it's a very legitimate concern because inflation is a much harder thing to tame, and it is something that we haven't seen in quite a while. So it's sort of an unknown at this point. But we know when the economy gets slow, we can gas it. So I think the Fed's being responsible here, and I think it's good for the market. I think the market's we're going to get what we need going forward. We're going to have some kind of pullback or correction here at some point, and we're in an ongoing bull market. Now, we may not get that first cut as soon as we hoped, but when we do, if we can maintain and keep this balancing act and we don't get a recession, as I pointed out, it has a very positive tendency. But we still, even if we don't get that, we still have a very positive tendency looking at the 4-year presidential cycle, looking at this decennial work, the cycle work. There's still a very strong tendency going into the second half of this year and the first half of 2025. So I'm still bullish on the market, but of course, if the stocks don't set up, I'll be in cash. And my bullish opinion will just be an opinion. So keep that in mind. I'm still bullish on Bitcoin. Um, the flows, I pointed this out, of course, in previous weeks, big flows. I think you're going to see some volatility, but when we're looking for a nice base to be built here, hopefully we're going to get, if you look at the weekly, you can see it definitely looks like it still needs work here. We're not there just yet, but I would look at the daily and look for some tightening, and you want to apply the same exact rule that you would apply to a stock, to this ETF, and that would be looking for a VCP, looking for volatility contraction, and that entry point. I know Mark Ritchie has pointed this out many times in our discussions and our Q&As, that looking at Bitcoin and many of the cryptocurrencies, our work, the type of technical work that we do, looking for the volatility contractions, the low cheats, the cheats, and so forth, has worked very well applying it to the charts of Bitcoin. The other thing I wanted to talk about, people have been talking about this Middle East tension, and that could cause a big problem in the market, a crash or something. Look, when you go back and you take a look, and we've got all the every crisis you can think of cataloged, and exactly what happened on the day of the crisis and what happened, a month later, 6 months later. And basically, whether it's even Pearl Harbor, their initial reaction was 6.5% drop, Korean War, 12%. If you take a look at all these, whether it's, and you can see here and go through these a whole bunch, I just pulled out the ones that were basically, war related that the U.S. was involved in some way or affected. And when you look at them, the average decline on the event was 2.62%, with the largest being, I think, yeah, 14%. There was a couple, a 12, a 13, and a 14. So again, it doesn't historically, it doesn't look like there's much risk as far. I wouldn't be too concerned about that. Um, More importantly is that there's a dearth of setups, and we're seeing dwindling portfolio traction. And dwindling traction on the focus list, and that's what's most important. That's what should guide your investment decisions, how invested you get, how aggressive you get with position sizing and so forth. STEM model being on red, that is a critical thing that you need to yield to, and to be very cautious when we're on red, at least applying our strategy. Distribution of 10 days, when we add the fact that we don't have the setups, we're not seeing the traction, stems on red, and now you've got distribution, 10 days of distribution on the index that has held up the best, and volatility moving to new highs, coming from very lofty sentiment and very poor participation. Well, I think, pullback is almost certain here, which we're in. You see it's happening beneath the surface. Whether it happens in what index, it doesn't matter. It's happening already beneath the surface. Um, or is it a major top? I don't think it's a major top, and I don't think Middle Eastern tensions are going to really cause any long-term effect, maybe short-term, depending on what happens there. So that's it in a nutshell. I think I covered a lot there just off the cuff. I hope it's been helpful, and we're pretty conservative right now as far as my view of the market here and what I'm willing to do personally, and what we're telling you to do, to take it easy right now and to be slow and stay small, and just be prepared for the opposite side of the trade, whatever side you're on. Be prepared for the opposite side, and be prepared for some volatility at this point, but be patient. Um, We'll uh, we'll see you. It's actually Saturday right now at about 10 o'clock at night. Traveling tomorrow, so I wanted to get this done for you guys tonight. I'll be racing some cars tomorrow all day. I won't be home till nighttime. So doing this tonight, I think we're gonna get it posted tonight. So hopefully it'll be up there for you tonight. Monday morning, of course, at 11:30 a.m. Eastern time, I'll see you for live Q&A with myself, Mark Ritchie, Bob Weissman, and also remember Thursday, Mark Ritchie and Brandon Hedgepath will be having their Q&A session. We also have been working on a bunch of enhancements on the platform, some things that you're not seeing yet, and it might take another month or two before you do see them, and some things that you'll be seeing really soon. And we're pushing forward too with a trade grader, and we're going to have a beta version. It's going to be a little clunky at first, but we're going to put something out for you guys to try and get your feedback. Okay? Talk to you soon. I hope you have a good rest of the weekend. Bye bye.